Hello everyone. In this video, we'll talk about underrated entry models, triangle patterns. We'll cover ascending triangle, descending triangle, symmetrical triangle. The reason these entry models are underrated lies in the incorrect construction and improper use of these patterns. First, let's look at the statistics for each of these models. It's important to understand the statistics are based on identified patterns without context consideration. When I say context, I mean higher time frame analysis. A simple example, don't look for bearish patterns within a strong uptrend. Context always adds win rate to any entry model. The presented statistics are fully automated, which eliminates the human factor and subjective interpretation. The statistics were collected on Bitcoin using the 5-minute chart. The best results are shown by the ascending triangle, and among bearish models, the symmetrical triangle. On gold, bullish patterns perform especially well. This is perfectly normal, considering that gold has recently been in a strong uptrend. When the market is systematically rising, it makes sense to focus on bullish formations rather than aggressively searching for short scenarios against the trend. The symmetrical triangle performs particularly well on gold. Its win rate is 68%. On silver, the symmetrical triangle shows the best performance. On the German index GER40, bullish models perform very well. On the American index S&P 500, the symmetrical triangle performs best. On Brent, black oil, the ascending triangle shows the best performance. If there are assets you would like to see statistics for, write in the comments and we will provide them. Now, let's talk about the correct construction and application of each of these models. Ascending triangle. This is a trend continuation pattern, so it is important to use it with the trend, not against it. If a bearish pattern appears within bullish order flow, we do not enter it. We are only interested in bullish models within bullish order flow and bearish models within bearish order flow. Now about construction. The formation of the triangle is based on two factors. One, equal highs. An important point that many confuse. The highs, or lows, do not have to be pip-to-pip identical. The key is that they are located approximately at the same level. There must be at least 2 touches, but there can be more, 3 or 4. 2. Higher lows. This is how the pattern forms on the chart. The stop loss in this model is placed behind the last low formed before the price consolidates above the equal highs. Descending triangle. This is the mirror situation of the ascending triangle. Equal lows and lower highs within a local range. The stop loss in the descending triangle is placed behind the last high formed before consolidation below the equal lows. An important factor that causes problems for many traders is entry confirmation after the model forms. Most often you will see the phrase strong consolidation above equal highs or below equal lows. The problem is that this wording is vague. There are no clear criteria for determining this on the chart. After a series of backtests, my team and I found the optimal confirmation method: formation of a bullish imbalance for a bullish model, formation of a bearish imbalance for a bearish model. For those who are not familiar, an imbalance is a 3-candle pattern where there is a price gap between the high and low of the first and third candles. This indicates that one side is ready to actively push the price in its direction. So, in the ascending triangle, confirmation for us is the formation of an imbalance within or above the equal highs zone. In the descending triangle, we want to see an imbalance form within or below the equal lows zone. Symmetrical triangle. This is a situation where, after an impulse, the market pauses and compression begins within a local range. Highs decrease, forming a descending trend line, and lows increase, forming an ascending trend line. This pattern works equally well in both bullish and bearish scenarios. The direction is determined by price consolidation. Above the highs trend line, bullish scenario. Below the lows trend line, bearish scenario. It is recommended to use the same imbalance confirmation method. An additional filtering factor is the medium-term trend. All statistics were provided for models on the 5-minute chart, so in this case, the medium-term trend is the 1-hour time frame. line. Stop loss, behind the last low for a bullish model, behind the last high for a bearish model. Important aspects to increase win rate. Run a series of backtests. Find at least 10 examples of each model and evaluate how they perform within your trading system. Trade patterns only with the trend. Remember, trend is your friend. Use imbalance as confirmation for entering a trade. Subscribe to the channel and leave a like. We wish you profitable trades.